Hello, hello everyone. Good morning. Hi, this is Sumit here, and I'm a partner at SmartWealth.ai. A very warm welcome to this webinar. Along with me, we have our founder and principal researcher Pankaj.
Hi everyone, welcome to this webinar.
This is a very special occasion for us, this particular webinar, because we have completed 4 years this Diwali. So we hope you have also had a good holidays and a good celebration of Diwali and Dashera with your families. Here's wishing you and your families a very happy Samvat. So let's get started. So we'll give you a moment to go through the disclaimers. And in the meantime, if you have any questions about what is being discussed in this webinar or otherwise, please feel free to reach out to us to these through these contact details which are mentioned here. And besides this, on our website, we also have our Google Meet links. So you can also set up a one-to-one meeting if needed with either me or Pankaj. And additionally, we also share a lot of market updates on our LinkedIn page. So you can also scan this QR code to follow us on LinkedIn. And with that, let me quickly talk about the structure of this webinar. So many things have happened in the recent past, as you might have noticed. So there were many important things like GST reforms. There were many crucial decisions taken in the RBI MPC meetings. There was a huge rally of precious metals, gold and silver. There were many geopolitical events which had an impact on the market. So we'll do a quick macroeconomic review in the first section. After that, in the next section, we are going to talk about the SmartWealth.ai algorithm and how it attempts to generate alpha in these kind of situations. In the third part, we are going to talk about overview and how our products have navigated the markets. And subsequently, we have also released a new small case this Diwali. It's a free small case, which is a simplified version of our bestseller, which is Aspire Diversified Stocks Portfolio. And finally, we are going to discuss some of the questions that we have received from you through various channels. So, with that, over to you, Pankaj.
Thanks Sumit for getting us started. So I'm going to start with macroeconomic review as the first topic. But before that, let me share that this Diwali was our fourth anniversary, and it's really a special occasion for us. We started SmartWealth.ai 4 years ago with the intent of helping working professional achieve accelerated financial independence. And it's really nice today to be presenting and having this webinar about fourth anniversary, coinciding with us. So to start with macroeconomic review, we are going to talk about three things. So we'll look at the policy review. What's the overall global policy situation? And then the second thing is we will review the bullion market, which is gold and silver. And in the end, we'll look at the capital flows, the FII, DIA situation. So the first topic is the policy review. So the most important driver or event affecting policy discussion is the RBI MPC that occurs once a month. And the highlights from RBI MPC is as follows. So first headline is that the inflation is low and it is controlled. So the headline inflation is 1.5%, which is very, very good, very low. The food inflation actually, in fact, is negative, which is minus 2.3. And, that's for a policymaker, that's one of the key consideration to keep the food inflation low, and negative is, I think, is excellent. The GDP growth rate estimates were 6.5% previously, which have been upgraded to 6.8%, which is excellent news, which is a sign that all the government spend that was undertaken, the reforms that were taken to simplify GST, to simplify the IT slabs, are indeed yielding some demand side pull. The last rate revision in June resulted in a rate decrease to 5.5%. After that, four consecutive reviews have shown a stable rate at 5.5%, which basically indicates that the RBI is maintaining a neutral stance. So it is really seeing economy expand, economy grow without having to undertake any incremental rate decreases. Inflation is low, so which means the regulator, which is RBI, has all the flexibility available in future to take even more aggressive action if needed. So really, um, the summary is inflation is under control. The economy is accelerating. The rate decrease is producing some impact, and it all the policy flexibility is available for use in future. The benefit of rate decrease on earnings should start showing in the next 1 or 2 quarters. So I'm very hopeful that these will produce impact in the coming 1 or 2 quarters. The situation in the US is as follows. So US is important for a couple of reasons. Not only US policy explains what's going to happen in US, it also explains what's going to happen in rest of the world. So how the capital will flow across various geographies, and how different asset classes are going to respond depend a lot on the US policy environment. And the Federal Open Market Committee in fact met on Wednesday, and the situation is not great. So, as a backdrop, the US economy, which is 35 trillion economy, is facing headwinds. So, the growth is slower than expected or slower than desired. There is a debt overhang. So, debt for a 30 trillion economy is a 38 trillion debt, which is exorbitant debt. So, the backdrop is that debt servicing is a challenge. And one of the major event that has occurred in the last 1 month is there is there's a fiscal budget sort of standoff, and because the government and the Senate failed to reach a conclusion, an agreement, the government is in a shutdown mode to cut the cost. So in that backdrop, the key numbers are as follows. So the inflation continues at 3%, which is higher than their 2% target. The economy has slowed down. The FOMC has executed or recommended two consecutive rate cuts of 25 basis points in order to accelerate the economy. So this is somewhat counterintuitive. The inflation is higher than expected, and yet there is a rate cut. So this is kind of showing that US regulators are pursuing an inflationary policy in order to achieve nominal GDP growth at the cost of inflation. Also, there's a phenomenon of balance sheet reduction. So the Fed itself is reducing its exposure to the US Treasury, which is kind of which is indicating that the Treasury, the Fed wants to reduce its exposure to USD. So potentially, there is a attempt to reduce the exposure to USD, perhaps to reduce the impact USD fluctuation might have on their treasury. Taking back, it's inflation is high. The GDP growth rate is somewhat under pressure. There have been two consecutive rate cuts, and seems like the regulator is pursuing an inflationary policy. The impact of this on overall world is that there is a global reserve realignment which is happening. So the global reserves used to have 71% of share to allocated to USD, and that has over a period of time reduced to 58%. So really the share of USD in global reserve is declining because the federal banks across the world want to reduce the exposure to USD. Also, the second fold impact is that the share of gold in global reserve is rising. So really, that is what I take back from this. And that also connects to the second part of the discussion, which is bullion review. So like I said, there has been a steady increase in allocation towards gold, and this is reflecting in the steady rise in gold prices over 1 decade, and largely driven by US macroeconomic signal. We also saw a little bit above average growth rate in gold and silver in the last 1 or 2 months. That was on account of festival demand. But overall, the parameter driving the reasons for growth are more permanent in nature. After the festival was season was over, towards the end, we also saw a correction in gold prices and silver prices. So this is not because something has structurally changed. All the drivers of gold and silver growth more or less remain active. This is on the account of profit booking. So this is more of a consolidation, not not capitulation. So that's about the Bullion review. The last aspect, one very interesting phenomenon that was observed was a rush in silver prices. So silvers were rising much faster than gold. In fact, if you look at 1 year review, the gold future prices have increased by 55%, whereas silver futures prices have increased by 65%. And this is explained by a simple phenomenon of parity. So gold and silver maintain a certain ratio among them, and somewhere in April May time frame, gold was accelerating while silver was not, and therefore this created a bit of lack of parity between them, and subsequently silver rose faster than gold, and they kind of reached towards a historical parity number. So the ratio of gold to silver is historically between 80 to 85 if you look at last 10-15 years of history. Whereas in the April May period, this ratio had reached to 105 range, and that is where you can see in the bottom chart on the left side, there was a spike from 80-90 level to 100-105 level, and gradually that has corrected back to 80-85 range. So which basically means there was a gap created, and silver had some catching up to do, and that catching up happened from April to October period, and now that catching up is over and the parity has been achieved. So I would expect silver to not have above average growth rate. Silver and gold are supposed to have somewhat similar rates, so the and that I would call a normal behavior. So above normal growth rate of silver, I think that correction is over. So taking a step back, so we saw India policy situation, we saw global policy situation, we saw gold situation. So let's put all of it together. Here's the the takeaway. The global economy is under is showing some signs of slowdown. In US, the inflation is higher than expected. The Fed has recommended two consecutive rate cuts of 25 basis points. This is showing that their regulator is pursuing an inflationary policy. The government is in a shutdown mode, which is essentially a cost-cutting measure. The net effect is that the gold will continue to see favorable environment. The equities might see some volatility, some pullback, and in India, the inflation is in control, GDP is faster than expected, and there hasn't been a rate cut in the last 4-5 months. So it kind of there is all the policy flexibility available for driving future growth. So actually, it's a pretty good picture for India, and it only gets better when we look at the capital flow situation. So if you take 5 year look back, 5 year back, the FIIs were 3 times larger. They had 3 times larger influence than DII. And if you compare that to now DIIs have 3 times the influence of the FII. So really the situation has dramatically inverted, and DIIs now really control the or drive the stability of the overall equity market, which is a great thing. And overall equity flows have quadrupled in the last 5 years, so which has also stabilized the equity valuation, and which is a good sign. So I think the net takeaway is yeah, the market has had a little bit turbulence in the last 1 year, but all the fundamental look good. The global picture is a little bit uncertain, but the Indian picture is getting stronger and emerging stronger every month. So with that, let's move to the second part, which is so there is a lot of variable and dynamics in global scene. How smart wealth drives alpha in this situation. So what's really our core thesis? Let's just quickly go through that. Um, so just starting with the basics, if you look at the picture on the left side, there's a 200 years history from US. It's from the book Stocks for Long Run. And you see a table which is, the real returns of different asset classes. There's no surprise that holding money as cash is actually negative real return. So it doesn't even meet inflation. The highest is stocks. So nothing is on the same order of magnitude as stocks by a large margin. So really, one thing is clear: the the fastest, most effective way of beating inflation and compounding your wealth is to participate in equities or stocks. Now let's look at the right side picture, um, which is India's equity index Nifty 50, the last 20 years. Now, this has had fantastic growth rate, 12% CAGR is very, very good. But if you look at the trajectory, it was not a straight, smooth trajectory. There were several periods of flat, 1, 2, 3 years, 6 years flat period. Also, if you look at drawdowns, there have been 60, 40, 20% drawdown, which is not a rare event. It happens almost as a matter of routine. So the issue is, how do we manage to participate in equity to maximize the participation in the upside while minimizing as much as possible participation in the drawdown? That, I would say, is the problem statement. And I would say that is intelligent risk taking, intelligent risk management. So with that, let's look at the second aspect. So is stock buy and hold? So while we have to participate, why don't we just buy and hold something? And is that a good stock selection mechanism? So let's consider this evidence on the left side. When Nifty 50 started, 1820, this data point is still a little bit old. So this is from 2014. And now the picture would be even more starkly in favor of what I'm just suggesting. So from that to now, more than two-thirds of the composition of Nifty has changed. So what it means is that even the best companies that actually formed this Nifty 50 index are not able to keep up with the index. So some of them got merged, demerged, delisted, or simply lost relevance. So that basically says to even just match Nifty 50 is very difficult for buy and hold kind of an approach. If you had bought and kept all the 50 companies of Nifty 50, two-thirds of that wouldn't have kept pace with Nifty 50. So really, buy and hold as a stock selection and sort of portfolio philosophy is not great. So how do we manage that? So on the right side is scientific evidence, which basically says prices of stocks are not purely random. In fact, prices of stocks have positive serial autocorrelation. So in other words, prices of stocks exhibit momentum, and this momentum exists in 3 to 12 months holding period. What it essentially means is that the last 3 to 12 months returns of stocks have some predictive power on the future returns of stocks, and this phenomenon is called price momentum. And this is what a good momentum strategy should do. It should study that momentum, and when you see momentum building, you take a position in that stock. So you will never be the first one to buy. You will buy when some amount of momentum has already happened. So, and then when the momentum ends, you would then detect and you will exit. So you will never be the first one to enter, never the first one to exit. So you'll, in some sense, you'll buy high but sell higher. You will not wait to buy low, and you'll also not hold it forever. So you'll capture most of the rally, or that's what you would attempt to do. So that's the philosophy. So buy and hold doesn't work. Is not the most effective way to beat the index. And price momentum seems to have scientific basis, and that's a good basis for stock selection and rebalancing. So the last part. So how should we form the portfolio? It's a very simple, commonsensical logic. So if you were to look at the bottom right of this table on the left side, so that represents the returns of an index, and this is from this book, Quantitative Momentum. It's a study of a very long period of time. So there are two drivers of sort of driving return. So one is if you make a portfolio more concentrated than the universe, you would tend to amplify the returns. And if you review this concentrated list or portfolio fast enough, more frequently enough, so that will also drive returns. So really, it's about managing the concentration and the frequency of the portfolio, which is selected on the basis of momentum, which is 4 to 12 months price change defined as momentum. So that's the way to drive return. So how do you manage risk? That's on the right side. So managing risk is essentially about having choices of uncorrelated assets to choose from and to combine them. So if you have a universe that consists of uncorrelated assets or uncorrelated alphas, that would reduce the standard deviation of your combined portfolio. And the more number of such uncorrelated assets you have in your portfolio, that is going to drive. So those are the two drivers. The the correlation coefficient among the universe and the number of such assets you have in your portfolio, that is going to drive the standard deviation towards a lower number. And as the standard deviation of your portfolio reduces, your return to risk ratio improves, the probability of losing money in any given year also reduces. So it's as simple as that. So we select a portfolio based on momentum, you drive return through concentration and revision, and then you structurally, programmatically drive diversification to deliver superior risk-adjusted return. This is what we do. This is the crux of our diversified momentum investing. This theory is translated into practice by this 3, 4, 5 sort of framework we have. So we have 3 types of portfolios: stock-based portfolios, assets-based portfolios, and factors-based portfolios, which is basically showing you diversity of universe and diversity of strategies. And these 3 strategies have possibility of 5 levels of diversification. So diversification across sectors, across market caps, across themes, across asset classes, and also across these strategies. And these are then brought to you as model portfolios under 4 sub brands or 4 subcategories, which are essentially 4 investor personas. So Aspire persona to manage up to 10 lakh rupees investments, then Sprint persona to manage up to 25 lakh investment, and then Endurance persona to manage up to 50 lakh investment, and Triumph persona to manage up to 75 lakh investment. So this is how this theory gets translated to practice. So moving on to the next topic, the market and product review. So in this section, we will review the assets, the themes, and the assets, factors, and themes. And side by side, we'll compare and see if this is what happened to assets. How did we navigate the situation in order to deliver the alpha, to capture the alpha as much as possible? So let's start with the first one, asset class review and diversified stocks portfolio. On the left side, you see asset classes, Nifty and debt. So equity and debt, this is not a great time to be in equity and debt. Last 1 year, equity have largely been flat and debt have been slightly negative, whereas gold has had a massive rally in the last 1 year. And on the right side, you see our Aspire Diversified Stocks Portfolio. Towards the right side, you see a square box. So that basically shows the last 1 year. The market was more or less flat, whereas this was able to capture some of the upside that we saw in gold, and as a result of which it performed slightly better than the equity indexes. This portfolio was launched at the start of our venture. So we launched this in December of 2021. It has completed more than 3 years. It is ranked number one momentum small case by 3 years return. And this has four layers of decision making. So first layer is a stocks layer, which forms a portfolio of stocks. The second layer is a ETF layer, which is a sector ETF layer, so which is a way to participate in equity even when stocks are not directly investable. The third layer is a debt layer, and the fourth layer is gold layer. So it basically has a dynamic decision making across sectors, themes, and capitalization levels. Also, it can bring in debt and gold when needed. The gold introduction or gold allocation is done dynamically, and that is how it sort of A mitigates the risk in equity asset class, and B drive stability and returns whenever there is an opportunity. And that kind of helped us achieve stability and performance in the last 1 year. Moving to the next one, which is factors. On the left side, you see Nifty, which is in black, and then you see two factors, which is alpha and low vol. You see in this that actually alpha has had a decline, which is 4% decline in the last 1 year. And low wall is about 2%. Nifty was around 7%. This is the time window is actually not 1 year, it's slightly less than 1 year. This product portfolio was launched in November of last year, so it's 11 months. So not a great time to be in equity, but even as a factor based portfolio, not a great time to be in factors either. And kind of on the right side, you see a table at the bottom of the chart. It shows that the universe consisted of alpha and low vol, two factors, and it had the possibility to have a gold hedge. When we started this portfolio in November of last year, that's when we launched this. The low vol and gold was the starting composition. It continued for some time, and you would see for most of last year, last 11 months, gold has been activated. The gold hedge has been active in this because the factors are not firing. And in fact, there are only 2 months. So February and July are the only 2 months when there was no gold. In all other months, there was some gold exposure. So which is showing, how we manage the risk that was there in the factors. Uh, if you just see the extent of drawdown, right? So on the left side, Nifty Alpha fell by as much as like 20%, but we did not fall by 20%. Likewise, even low wall fell by, let's say, about 10% or so. So despite having a factors-based strategy, because of gold hedging, this helped us mitigate the risk. In fact, if you see two portions, the first couple of months and the last couple of months, we were able to significantly mitigate the downward pressure in the universe through gold hedging. And while it started with low wall, there was a brief period when alpha as a factor also became relevant, which is June-July period. But as we stand, we are back to pretty much similar composition like we had about 11 months ago. Overall, it has achieved performance even in a tough environment, and it has been very successful in reducing the drawdown in equity, as more specifically in factors universe, and it is a good diversifier because it has low correlation with the stock portfolio, and as a result of which those who may be holding Aspire Diversified Stocks Portfolio may find this as a good opportunity to diversify and sort of mitigate some of the risk of stocks portfolio. So moving on to the last part, last portfolio or last strategy that we have, which is uh, themes and thematics. So on the left side, you see two charts, which is review of themes. It is broken into two parts. We launched this portfolio in July, which is about a quarter ago. The chart on the left is the picture before the launch. So how the market and themes were behaving before the launch. The second chart is how they have behaved after the launch. So in April to June period, immediately preceding the launch, almost all the major themes were doing very well. So capital markets and defense were among the front runners. We were holding them in the initial launch portfolio. Thereafter, if you see, most of the portfolio, most of the themes have underperformed the Nifty. Not only underperformed Nifty, they are underwater, below zero. While sectors and themes have seen that kind of a dip, our portfolio has not seen that kind of a dip because of a couple of reasons. One, it's a diversified portfolio, even though it does not diversify across asset class. It does not go to debt or gold. Even within themes, it diversifies across three themes. So defense, capital, and oil and gas. So while they face pressure, some amount of risk management happens because of diversification. Also, these themes are reviewed once a month. So once we see that okay, there is pressure in some themes, it can move to other themes. So in fact, when defense was under pressure, we moved to some other themes. And overall, considering the turbulence among themes, I think it has done it has performed in a fairly stable manner. We did see one black swan event. So under capital markets, there was one stock that we were holding, which is IEX. It's a energy exchange, and it witnessed almost an overnight 30% crash. It happened so fast that we had to face it, and this caused some impact on our performance. Although the net impact of this is not very substantial, overall portfolio has performed fairly stable for a thematic portfolio. And we expect this to continue to do better as market improves. Overall expectation among analysts is that Indian equity market should do better over the next 1 or 2 quarters as the earnings improve. And as earnings improve, things should also improve, and this portfolio should do better than this. With that, let's come to the last section, product launch and offer. In this Dashera Diwali season for Vikram Samvat, we created this free portfolio, which essentially is a thoughtfully simplified version of our bestseller, our flagship product, Aspire Diversified Stocks Portfolio, with a couple of differences, which I will explain. But it essentially brings the advantage of a gold hedge and combines that with the growth potential of stocks, which is a better way to manage money, a smarter way to manage money than passive ETFs. And it is quarterly rebalanced. It's not a very fast rebalanced portfolio, which is fairly effortless for the advantage that it brings. It allocates 60% to the gold ETF and 40% to 4 high momentum stocks. And these stocks are selected from a broad liquid universe. And this has the possibility to catch leadership trends which may be missed by static indexes. And considering that it's a quarterly rebalanced portfolio, the effort is quite low. The portfolio churn is also quite low. Thereby, it ensures lower transaction cost and better cost efficiency. The selection is via an algorithm, so it removes the emotional bias from decision making, makes the decision making more consistent. It brings the advantage or robustness from risk management. When the stocks become volatile, it exits those stocks, thereby it controls the drawdown. So it has the ability to go from stocks to cash if needed. So we use interest rate linked ETF for parking cash in the period when stocks may not be investable, or we don't find all four stocks meeting all the criteria. So this is a great way to invest. It has two major differences versus Aspire Diversified Stocks Portfolio. Aspire Diversified Stocks Portfolio is weekly rebalance, whereas this is quarterly rebalance. Aspire Diversified Stocks Portfolio has a dynamic gold hedge, whereas here we have a fixed 60% allocation, and that actually allows us to have a longer holding period, and sort of manage money in a smarter, calmer way, and continue to beat market consistently, fairly consistently, without taking risk of a equity market index. So that is what this portfolio does. I encourage you to check it out. It's a free portfolio, and it may be a good way to get started with a stocks based investment, especially when you may be participating in passive ETFs. The last part, which is Aspire Diversified Stocks Portfolio. Like I said earlier, I'm very happy to share this we started SmartWealth.ai with this portfolio. It has completed 3 years. It's going to complete 4 years later this year. But for by 3 years return, it's ranked number one momentum small case among the universe that of momentum small cases. You can watchlist this portfolio by scanning this QR code. There is a 15% discount on this, which you can avail using value 15 promo code. It's a limited time offer. I encourage you to use it and watchlist this portfolio. If you have any questions or any suggestion, feedback, we would love to hear from you. You can drop us an email or call us and reach out to us. With that, Sumit, I pass this back to you, and I'm happy to answer any questions that may have come from various channels.
Yeah, thank you, Pankaj. So I'll just quickly read out some of the questions that we have received to you.
Yeah.
So, okay, this one has been asked by many investors. So, one is given the rally and the recent correction in gold prices, how do you see the market moving in the near term and the midterm?
So the question is about gold having had a massive rally and a minor, what do you say, a
Correction. Yeah.
consolidation phase. So is gold still a good bet?
Yes.
So if you look at the drivers of gold growth, it is essentially led, the one of the primary reason for gold rally is a global reserves realignment. So 71% of global reserves were in USD, and that number has reduced to 58%. So substantial amount of global Federal Reserve is actually moving to gold. That is one of the major driver, and the reason for that is macroeconomic situation of the US. So US is facing growth pressure. US has high debt. US has high inflation, and yet it is pursuing low interest rate policy, which is inflationary growth policy. So, would any of these drivers go away in near future? So, I don't see US debt reducing dramatically in short term. I don't see, the inflation and thereby the monetary policy changing in any time soon. So, it's all the drivers are fairly permanent, fairly long time term. Therefore, gold as a good candidate for hedging will continue in future as well. Although we may not see these kind of growth rates that we've seen in the last 1 year.
Okay. Okay, and the next one is about equity markets remaining largely flat, for some time, at least a year or so. You also touched upon that in the macroeconomic review.
Yeah.
So, what is the outlook for equity markets?
So that's a great question. So the market has been flat for a year. The quarterly earnings in September of 2024, and then that quarter, and then even December quarter, they were not great. So market was under pressure. Subsequently, we saw the March quarter and June quarter results were slightly better. And a lot of effort has been policy effort has been undertaken by the government. So there's government spending in three new sectors. There is taxation rationalization for IT, which is IT slab restructuring, then GST slab restructuring, etc. So which has created some consumer pull. The government was very sensitive to controlling inflation. The inflation has come down to control. The the rate cut that occurred in June, the benefit of that should start showing in the earnings improvement over the next 1 or 2 quarters. So over the next 1 or 2 quarters, we should see earnings improvement and general positive, positive sort of sentiment in equity market. That is what I expect. And after that, still the federal bank has all the policy options available, all the flexibility available to drive growth. So I think given that economy is already on a growth track, 6.5 to 6.8%, inflation is low, and the real benefits of rate decreases have not yet started flowing. I would expect next 6 to 12 months to be good for equity.
Okay. And the next question is from one of the subscribers of the Samvat portfolio. So they are asking, I think you briefly touched upon this also just now, but maybe if you can elaborate a bit, what is the difference between the Aspire Diversified Stocks Portfolio and the Samvat portfolio?
So, Samvat portfolio is draws inspiration from Aspire Diversified Stocks Portfolio, but it's a thoughtfully simplified version of stocks portfolio. And it is simplified in two key aspects. So, one aspect is that stocks portfolio, the Aspire stocks portfolio is a weekly rebalanced portfolio. So that is reduced, the frequency of review is reduced. So in Samvat portfolio, it is a quarterly reviewed, and as a result of which, it has less churn, less transaction cost, uh, and it has fixed gold percentage, which is fixed at 60%, as a result of which the portfolio is a little bit more stable and it can withhold a slower rebalance frequency of quarterly review. Whereas Aspire Diversified Stocks Portfolio has a dynamic gold hedge. So those are the two major differences. But what's same? What is same is they both bring the asset class diversification. They both bring the power of growth that can come from stocks, and they both bring the thoughtfully selected framework of diversified momentum investing. So the stocks are selected via a robust process of liquidity check, volatility check, and they are by design diversified across sectors, themes, etc. So they bring the growth potential of stocks and the stability of gold, and in a low effort, low churn manner, they should beat passive ETF kind of investing. Also, it should beat the equity market index, especially in terms of risk mitigation.
Okay. So this is the final question I have, Pankaj. It's about entering the equity markets at this moment. So
Yeah.
for investors who are trying to enter right now, do you think it's a favorable entry point?
So the last 1 year has been flat. So if we have had any concern about equity markets being overheated, overvalued, I think all those concerns have substantially reduced. That's one part. The second part is the economy is still growing and it's accelerating. So considering that economy is growing and accelerating, and the equity markets have consolidated for last 1 year, and the real benefits of rate cut have not started flowing yet. So I would say it's a good time to invest. Like they say, the best time to invest was 20 years ago. The second best is now. But but the right thing to do when you're entering the market is to stagger your investments. So we don't want, very high exposure to the price point in any very narrow time window. So it's best to invest gradually, sort of invest over a period of time.
Right. Okay, thanks, Pankaj, for answering those questions. So that brings us to the end of this session. I would like to thank everyone for joining this. And if you have any further questions about the portfolios or any other related topic, please feel free to reach out to us. Our details are already shared in this presentation, and also I'll reiterate again, then you can also set up a one-to-one meeting with us through the links provided on our website. So thank you very much. Pankaj, you want to say anything else?
Well, thank you very much for taking time out on this Sunday. We would love to have your feedback and any open questions that you might have. So, thank you very much for joining and looking forward to staying in touch with you. Thank you.
Thank you very much. See you next time. Bye bye.
Bye.